Last week, Morgan Stanley announced that they're forecasting 7 rate cuts in 2026. If that actually happens, it would mean mortgage rates as low as 4.5% next year. Is that really possible? I think it could be, and we'll discuss in a minute. Mortgage rates are finally dropping again this week, and they're actually the lowest they've been since April, and pretty close to the yearly lows. We still have way more people applying for mortgages now than we did a year ago. We're definitely through the sales peak for the year, which means the number of sales and probably home prices will be cooling off for the rest of the year. New listings finally had a welcome bounce this week after struggling for the last few weeks, and the number of homes having price cuts every week finally stopped going up. We're covering all this and much more in this week's market update. My name is Michael. I'm a local real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is June 30th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here to get to the latest weekly market update. Starting with market news. It's no secret that President Trump wants the current Fed President, Jerome Powell, to be out of there. But he can't fire him, and Powell's term doesn't expire until May of next year. So Trump's new strategy is going to be to install a shadow Fed president. He is going to let everyone know that what Powell says doesn't matter anymore because his time is almost up. So the person you really need to be listening to is whoever Trump is going to pick next. He's the guy who's going to be able to tell you what's really coming next year. So President Trump announced on Wednesday that he's identified several candidates for the next Fed president. So Trump is going to be selecting a new Fed president a year ahead of time so they can start communicating what the Fed's new policy is actually going to be to the global markets. The goal, of course, is to undermine Powell and signal to the global market that rate cuts are coming as soon as Powell is out. Now, this isn't going to bring any immediate changes for you and me, but the new shadow Fed president is going to be able to start clearly communicating what their policy will be moving forward and start using that current softening labor data to show that the labor market is weak enough already and that Powell's current approach of waiting until something breaks before cutting rates is going to be a thing of the past. This way, as bond traders start seeing more and more weakness in the labor market with every report that comes out, it could cause them to buy more bonds now, which would send mortgage rates lower. On Wednesday, the Fed also announced a proposal to ease regulations on financial institutions to allow them to hold more treasuries on their books. This would mean more buyers for bonds, which would lower bond yields and in turn lower mortgage rates. Then on top of all this, we got what would normally have been a very unusual announcement from Morgan Stanley on Wednesday saying they expect the Fed to deliver 7 rate cuts in 2026, starting in March, which again is 2 months before Powell will be out. So it sounds like they're expecting that the minute that Powell is out, rates are going to be coming straight down. And with 7 rate cuts, that puts the federal funds rate somewhere around 2.5% to 2.75%. And if the federal funds rate gets that low, it's going to mean mortgage rates somewhere between 4.5% to about 5.25%. But is it realistic for the federal funds rate to get that low? Well, Powell himself has said from the beginning on live television that the Fed would like its policy to mirror the 3, 6, and 12-month PCE inflation numbers, which right now would put us about exactly at that 2.5% to 2.75%. So if that were to happen, it's actually what Powell said he would like to happen in the first place. And obviously, if mortgage rates do get all the way down to 4.5%, we're going to be having way more real estate sales than we are now. So let's look at some charts. This first chart shows existing home sales. Now, this doesn't include new construction, but you can see very clearly over the last 2 years, we have found a bottom here around 4 million annual sales. But all you can see here is once mortgage rates spiked up, we had a crash in sales, and we've now been building a 2-year base here around 4 million sales. You can see very clearly that a crash did happen in sales. And we have a strong base here. You can see it again here, and it's the old resistance over here. I mean, this line is clearly very important. You see it here, it almost touched here, spent some time around that line here. During the 2008 crash, it landed down here as well. And now we're right back here again. So there is a very, very strong support in the US housing market around 4 million sales a year, which means we're not going to be seeing less sales than we're seeing now. We have been bottomed out, which takes us to the pending sales chart, where you can see for the last 3 years around this time period, every year we are seeing growth. It's a very small growth, but it is growing. Which brings us to the pending home sales chart, where you can see over the last 3 years, that's these 3 lines, little by little we are seeing more and more growth in pending sales, in the number of sales happening. And you can see this year, starting back here between March and April, this year's sales started outpacing last year's sales all the way up until this week. We're almost exactly tied with where we were last week, but that's just 1 week data. You can see the trend is clearly more sales happening than last year. And as recently as last week, we actually had 2.43% more homes pending than we did a year ago. So you can see the trend is every year we are growing in sales little by little, even without mortgage rates coming down. Which brings us to inventory. And for some reason, the sentiment out there seems to be that there is so much inventory that the housing market is going to crash. But let's look at reality. And actually, let's look at this chart. This is the total housing inventory over since it was started being tracked in the 80s. Again, you can see with housing inventory, we had a very strong bottom here. We broke that and we are now just coming up to retest it. We are still incredibly low on housing inventory. And you can see that a regular market would be way up here. If we drew a line through it, it would be somewhere at least having 2 million homes for sale at minimum. So we're nowhere near having enough inventory for a regular market, which means if mortgage rates were to go down to that 4.5% today, we would be in big trouble because we would have a normal amount of home buyer demand and nowhere near a normal amount of home buyer inventory. A normal level of home buyer demand would eat up this little inventory and drive prices through the roof. So what's happening now is the market is healing itself. High mortgage rates are keeping buyers on the sidelines, which is giving us time to build that strong base around 4 million homes a year and giving this inventory time to grow, though it definitely needs to grow more than this before rates drop. So it's possible that 1 year from now, inventory gets much closer to normal, somewhere up here, just in time for the new Fed president and finally the Fed to actually cut rates, giving us those lower rates down in the 4s and 5s. So that actually all seems very reasonable to me. But what that also means is between now and a year from now, when all of that happens, inventory is probably going to continue outpacing home buyer demand as long as rates stay up here, which means you're going to see higher days on market and likely more price cuts. But know that this is going to be a temporary thing. And it's also something that needs to happen for all the reasons I've just outlined. We do not want lower mortgage rates until we have enough inventory to support a regular amount of home buyer demand. This is just a part of the cycle. The housing market will continue cooling and prices will likely decline until rates drop and buyers return, which will give us a chance to stack up enough inventory. So I think a 1 year timeline is very reasonable for all of this to happen. Okay, moving on, let's start with national housing inventory. This week we had an increase, a very small one, of just 2,220 more homes for sale in the country. And this drops us another 2%. That's the second week in a row we've dropped 2%. We're down to 29% more inventory than we had last year. Most of the year we were around 35% more inventory, and that gap is shrinking a little bit. We're down to 29%, but that's still way better than last year. But we're at a total of 831,110 homes available for sale in the country today. And this same week last year, that big gap you see, we only had 635,713 homes for sale. So again, this is what we need. We need inventory to continue growing, and at least we're 29% more than we had last year. Then for reference, the all-time inventory bottom here of 2022, we only had 240,000 homes for sale. The peak of last year, we had 739,000 homes for sale, but we need to get way up here at least to this line. Now looking at new listings, you can see after this big drop, we've been struggling to recover. We're actually not even back to our highest point for the year, and it's likely we're not going to get there. But this week we had 4,882 more new listings than we had last week for a total of 81,063 new listings this week. Again, we need inventory to grow. We want more new listings to come onto the market. Either way, we're doing better than the 2 previous years, just not better than 2022. Now looking at pending sales, obviously from back here, they've begun their descent down for the year. That's very obvious looking at all of these charts. The market is going to be cooling from here on out, and this week we had 1,024 less homes pending compared to last year. So we're 1,000 homes below that previous red line for a total of 396,741 homes under contract. Again, that's just 1 week data. It could bounce right back up over that. You can see it happened here as well, where we got very close to last year's line. Overall, we're just looking for the trend, and the trend is obviously still growth for now, even with higher mortgage rates. Then this week, I'm adding a new chart, which is the weekly pending sales. You can just call this new contracts this week. And I want you to see that even though those total pending contracts declined, the new contracts this week actually increased by 3,778, and overall, year over year, that's 11.23% more than the same week last year. So 74,130 new homes went under contract this week. Then finally, the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, for the first time since April, we did not see a weekly increase. We were completely flat. We stayed at 40%. That's exactly what we were last week. And as you can see, that's almost exactly where the peak was for last year. And once we hit that, we just kind of went sideways and a little bit down for the rest of the year. So I don't know if that's going to happen again this year, but that would be pretty much exactly what happened the year before. And the same, I remember when this line started sloping up a lot sooner than the previous year. People thought it was going to continue up, but really once it hit slightly above the previous year's peak, that's when it flattened out. So we may flatten out here, we may go up a little higher, but just know it's also possible that this may have peaked for the year, even though the slope started sooner. But last year we got as high as 39.9%, the year before 39.2%, and then back in 2022, the first time that rates went straight up through the roof, we got as high as 43.2%. But just know, if you want home prices to be coming down, this number will need to continue up. And then for further context, the slope of this red line and ending up around that 40%, the result of this many price cuts was an annual home price increase of about 4.5% in 2024. So we'll have to wait and see what happens for this year. Personally, I'm expecting a less than 2% year over year growth in prices. Okay, moving on to mortgage rates, you can see we finally had a big drop back to about this cluster, which is the lowest we've been for the year other than these 2 days where we got way down here to like 6.6. Outside of those 2 days, we're pretty much at the yearly lows, which were around the 6.7s, and we're currently at the 6.72. So we started the week at 6.84 and got as low as 6.72, which is about as low as we've been for the year. Then looking at the mortgage purchase application index, this just tracks the number of people applying for mortgages every week, not for refinances. This is only for people looking to buy. We had a small decrease this week, but even so, we are up 13.2% year over year in the number of people applying for mortgages this week, which gives us 18 straight weeks of positive year over year growth. And this data will show up 30 to 90 days from now in sales. So this is people who are just now starting to get approved. It's going to take them some time to contract and to close. So 30 to 90 days from now, I would expect that we are still going to see that pending sales line higher than where it was last year. But again, there is no reason to believe mortgage demand is going to grow any faster than this, or that pending sales are going to grow more significantly until mortgage rates drop and get at or below 6% for a sustained period of time. We know this because new construction has been offering below 6% rates for years now, and they've been selling way more efficiently than pre-owned homes. So this looks like some big growth, but that's only because we're working off of record low numbers. So every little change seems huge, but neither of these years are anywhere near what normal mortgage demand would look like. Okay, let's move on. Okay, now we're moving on to the local markets, starting with the MLS data of Dallas County. This week we had 640 new listings in Dallas County. That's 24 less than last week. We had 356 closings. That's 38 more than last week. Of the homes that closed, 66 were immediate sales, meaning they contracted in the first week. That's 3 more than last week. However, total new contracts in Dallas County saw a big drop this week of 57 less homes, all the way down to 286. So a very slow week in Dallas County. And in total, we have 2,344 homes either under contract or pending in Dallas County. That's 58 less than last week. Now moving on to Collin County, we had 551 new listings. That's 18 more than last week. 338 closings, 30 more than last week. So a lot of closings the last 2 weeks in Collin County. Of the homes closed, 63 were immediate sales, meaning they contracted in the first week. That's 16 more than last week. Unlike Dallas, they actually had a 24 increase in the number of new contracts, up to 237 homes. And in total, they have 2,062 homes either under contract or pending. That's 15 less than last week. Now moving on to the Market Action Index. If you've never seen it, it takes into account all this data, puts it into one easy to read graphic with a number. Anything of 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in. We are still at a 30 36, which is just a slight seller's advantage here in Dallas County. Not a lot of movement this week. Prices remained pretty flat. Yeah, I mean, less than $1,000 difference in the median list price. Median price of new listings is still just going sideways, up and down in a very tight range. Average days on market stayed completely flat from last week. Median as well remained at 56. Number of homes having price decreases went slightly up, though it's still not at the peak of where it was. So pretty consistent with the national market, flat on the number of homes having price decreases. Inventory, you can just see a nice slow steady trend up, exactly what we're hoping to see. And the market action index had a pretty flat week. Yeah, 0.43 to 0.41, that's totally flat. So it didn't really go down this week. So you can see the trend has definitely been down, but at least for the last week, it has stopped going down. So we'll have to wait and see what happens next. Now looking at the same thing, but for Collin County. Collin County has generally been cooler than Dallas County. It's at a 34, a slight seller's advantage. But you can see already they cooled off a little more, but definitely not as quickly. You can see the slope of that line, and then this week it was a much slower decline. But their median list price remains for the last 3 weeks at $550. Their median price of new listings as well. I said when we had this drop last week, it's likely it's going to bounce back up. They're just like Dallas County, staying in a tight range. So prices are definitely remaining flat, both median list and the price of new listings. Average days on market increased by 2. Median days on market finally had a jump up. And for whatever reason, this chart only tracks 7-day increments. So it'll just round up when it gets close to the next week. But you can see it's a sign that the market is slowing. We've been at 42 for a while. We finally jumped up to 49. I expect we'll be there for several weeks to come. Their number of homes having price decreases as well is continuing up. So they're already a lot higher than Dallas County, and they're continuing to have more price decreases. Their inventory had a pretty flat week. You can see it's nowhere near what the slope has been. It did increase, by about 30 homes maybe. And like we said, their market action index as well looked pretty flat compared to this downward slope. So overall, a pretty flat week, but everything that's happening here is totally normal for this time of the year. The market should be cooling from here on out. We're not seeing it yet in the list price data because we are still in the summer. There are still a good amount of sales happening, but prices should not be going up. Days on market should not be going down. Everything that you're seeing here is normal. Okay, now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. These are ranked using that same market action index number we just discussed. Remember, 30 or below would be a buyer's market. Starting with the hottest cities, the hottest remains this week and has been for several weeks. Grapevine, Texas at a 45.47. Then Lancaster and Coppell, those all three remain the top 3 spots. Then Richardson heats up 1, Carrollton cools off 1, Grand Prairie remains, Duncanville heats up 1, Louisville cools off 1, Hutchins remains at number 9, and Irving jumps onto the list to replace Garland, Texas. So not a ton of changes this week. Then we like to zoom into specific zip codes. The absolute hottest is Irving, Texas at a 47.19, followed by Dallas 75253, Lancaster 75134, Grapevine 76051, Richardson 75082, Richardson 75080, Irving 75060, Grand Prairie 75052, Coppell 75019, and Lancaster 75146. So if you have a home in one of these zip codes, you should be able to sell for top dollar. Then same thing, looking at the coolest cities, the coolest remains Whitewright at a 27.91, followed by Blue Ridge, that remains, and then Rockwall cools off 1 to take the 3rd spot. Leonard cools off 2, Van Alstyne heats up 2, Salina heats up 1, Lavon and Royce City remain. Prosper jumps back onto the list at number 9 this week. Nevada heats up 1, and then Ferris, which was number 10 last week, heated up off the coolest cities list. So anything Salina or above, all of these are buyer's markets because they're below 30. Then zooming into specific zip codes, the absolute coolest is all the way down at a 24.92. That's very firmly a buyer's market. That is Dallas 75204, followed by Rockwall 75032, Whitewright 75491, Blue Ridge 75424, Wilmer 75172, Dallas 75219, Dallas 75254, Dallas 75235, Leonard 75452, and Van Alstyne 75495, and all of these are buyer's markets. Remember, if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.